All right, so the question today is, what is happening with mortgage rates? You know, in the last couple of weeks, we've seen mortgage rates drop. And so what I want to do is I want to take you through a few slides and break down exactly what's happening. You know, I have this picture here of this roller coaster, and what I can tell here is it looks like the people are upside down, but I can't tell if they're going higher, they're coming down, what it is, and maybe that's a good picture for what's happening in the market right now. They're kind of interest rates, mortgage rates are all over the place. We don't know what's happening, and I'm going to try to clarify this so that you can clarify it for the clients that you serve. And I've got 6 slides to kind of break down here for that. We'll start here with a quote from Lawrence Yun, the chief economist at the National Association of Realtors, and he says this: "A return to a normal spread between the government borrowing rate and the home purchase borrowing rate will bring the 30-year mortgage rate down to around 6%. What's he talking about there? He's talking about the 10-year Treasury and the 30-year mortgage rate, which is, you know, versus the home purchase borrowing rate. And if I were to give you a visual that best sums this up, it would be this visual right here. And we know that for the past 50 years, the 10-year Treasury has moved in unison with the 30-year mortgage rate. So you ever want to know what's happening with mortgage rates, watch the 10-year Treasury. They've had this symbiotic relationship over time that we can look back to. And you see the average spread there, 1.7% in the orange, or call that 170 basis points, however you want to look at that. So if you literally took the 10-year Treasury rate, you added 1.7%, you'd be in the neighborhood of where the 30-year fixed mortgage rate would be. So let's sort of talk about that. And I'm going to give you a slide here and kind of run through 3 scenarios that show you where we've been, where we're at right now, and where we're going, okay? Because I think it's critically important that we understand that right now. So this slide right here, why are mortgage rates not at 5.5%? And it's all about the increase in spread right now. Okay, so first point here, if we look to the left side of the screen and drew kind of a red box around that, between 2000 and 2021, the average mortgage rate was almost 5.3%, 5.28 to be exact. And what that was a 10-year Treasury rate of 3.49%, the yield on the 10-year Treasury, and the spread there, the difference, was 1.79, giving us this average mortgage rate right there if we start to look at that. Well, where are we at today? You know, and these are going to vary from day to day, and kind of take this middle box here. 10-year Treasury yield at 3.73, and again, depending on the day, that's going to fluctuate. The spread's going to fluctuate. And a spread of 3.35%, giving us an average mortgage rate just over 7%. Now, in the last week, we've seen mortgage rates fall just below 7%, and I think expecting some volatility is what we should expect right now. But the interest rate today is all a factor of where's the 10-year at and where's the spread at. The spread really is a factor of the premium that mortgage companies are placing on mortgages right now, because essentially they know they'll be refinanced. So they're saying, if we're going to do a loan, we're going to charge more for it because we know it's going to be refinanced as soon as rates come down. Well, let's continue on the story in this last red box here. Where would they be today if the spread was normalized? Well, if the spread was normalized, we'd see the 10-year Treasury at 3.73. We'd see this normal spread we saw 2000 to 2021 of 1.79%, putting us right about 5.5% on the average 30-year fix. Now, here's what's important about that. As we go into next year, I believe this is the direction we're heading. Certainly it's suggested and favored by experts, and I'm going to show you that in just a minute. It's just a matter of time. How long is it going to take us to get there to where we get a little bit of relief on the spread and a little bit of relief in the 10-year Treasury? And so I think that's what we can expect going forward. But I want to give you 3 perspectives of what experts are saying right now about the future of mortgage rates, because here's where this gets important. How are we coaching those that we're working through to understand what's happening in the mortgage market? First one from Allie Wolf, chief economist at Zonda. She says this: the housing market is expected to face continued uncertainty heading into 2023 as consumers, financial markets, and policymakers work through their respective challenges in today's economy. So what's Allie saying? Expect the market to be volatile and uncertain as we go through the next several months. I think it's very, very good advice from Ali Wolf. Next one, Barry Habib from MBS Highway, probably one of the leading authorities on the secondary mortgage market in this country. Because we see a slowdown, and we see a slowdown, and when we see the inflation comparisons start to become more and more unfavorable, you'll start to see the inflation number move lower, 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 lower. And as a result, he says mortgage rates should move similarly on a downward trajectory, probably giving us around 5, maybe below 5% within the next 6 months. What's he saying right here? We're starting to see the hints of lower inflation. I wouldn't say we're out of the woods yet, but we're starting to see those hints, and that's why we've seen a little bit of relief in the mortgage rate. And the mortgage market is essentially looking for good information, good news to come out, about inflation. And when we start to see that, we'll see relief on these rates. Last one before I close up here. Bill McBride with Calculated Risk said that my current view is inflation will ease quicker than the Fed currently expects. That's positive news on the front of interest rates, mortgage rates specifically, because inflation is always the enemy of long-term interest rates. As inflation's high, we'll see high mortgage rates. But as inflation starts to come down, we'll see relief in mortgage rates. My hope is that as you go through this, you have more information and you're better educated so that you can be the authority in your market about what's to come as we go through the end of this year and into 2023 and give the best advice to the clients you serve. As always, we want you to go in and start a free trial of Keeping Current Matters. You can go to trykcm.com and start that free trial. Grab these slides and use those to be the knowledge broker to the clients you serve.